We'll kick things off. So the reason I thought I'd basically kind of run this tonight is unless you've been living under a rock, you're probably pretty aware that we're heading into some pretty challenging times, I think, in 2023. And so there's no one kind of better to get along than Cameron Bagrie. I'm pretty sure most of you will probably know a fair bit of Cameron's background, but he's been an economist for about 20 years, with 11 years of that kind of heading up our largest bank, ANZ, as chief economist. Also worked for Treasury and Stats New Zealand, and is now running his own boutique kind of research firm, Bagrie Economics, and as well as another business, Chaperone, which helps navigate kind of businesses and having to deal with banks. So I think we'll start off kind of having a bit of a talk about kind of interest rates, because I think cost of living is kind of sitting there as being a pretty painful subject for New Zealanders, and most of you online are going to be sitting there having mortgages to navigate in a market where rates are rising rapidly. So I suppose starting off, Cameron, obviously it's about, I think, a month ago we saw some pretty scary inflation numbers come out. I think the market's pretty much immediately kind of started to signal that next week's OCR review is going to go up, I think, 75 basis points. A lot of people are talking, and then kind of followed maybe by a couple of further large increases next year. I think I've read some parts you've come out and said you think they could be pretty dangerous if they push that hard.
Yeah, I think if we were in a normal climate and you've got this sort of tightening that the Reserve Bank has delivered, and we know that the tightening so far is sort of around the edges. People haven't really felt it yet. So if you look at banks' lending books, the typical loan out there across their books is 3.8, 3.9%. So it's up off its low around 2.7, 2.8. But if you look at where the fixed mortgage book is at the moment, you're up around 6. So we know there's 200 basis points of tightening to come. Now, you'd want to be nervous about that if you're a central bank in a normal climate, because you wouldn't want to over-engineer the slowdown on the other side. The problem we've got at the moment is basically twofold. And let's put aside headline inflation today, because the Reserve Bank can do nothing about headline inflation today. The two big problems they've got is that a labour market that's as strong as an ox. Now that's a good thing. Unemployment 3.3%, wage gains are turbocharged. We're seeing real big household income lifts. Problem is we're into that too much of a good party zone sort of thing where it's starting to add to an inflationary pressure. And unfortunately, we're in a bit of an awkward situation at the moment. We need the labour market to cool. And you get out there and you talk to firms at the moment, everybody seems to want to hire staff. And one of the real problem indicators the Reserve Bank has seen, and it's only been in the last week, was their inflation expectation survey. Now, inflation expectations are the lifeblood of a central bank's credibility. Now, the 2-year measure went from 3.1 to 3.6. Now, you think about it, that's inflation 2 years out. Yeah. We've already had almost a couple of years of inflation being pretty high. And these are professional people are saying inflation is still going to be 3.6 2 years out. Now, that goes right to the heart of how much credibility does the Reserve Bank actually have to get inflation back down. So prior to those numbers, I thought the Reserve Bank would go 50. Now, those numbers, you've got to get out there and deliver a bit of a hit. And let's not forget that the Reserve Bank does not get to tweak interest rates again until February next year. So odds are they're going to be a little bit more heavy-handed in the near term. But I guess the good news is that the market's sort of anticipating this. Not quite. The market's divided between 50 versus 75 basis points. But in central banks, live or die on credibility. And at the moment, inflation expectations are telling central banks, we're not quite sure how much credibility you've got. And they've got to get it back. So they're going to go hard.
On the credibility issue, that's actually one of the key things I wanted to have a talk about, because obviously it's been all over the news, the reappointment of Adrian Orr. You had a lot of people kind of come out pretty much immediately. I think I saw Oliver Hart, which was quoted in Business Desk, which obviously right for, saying he wouldn't recommend they print his views on the reappointment. I think there was Brad Olsen, who's another economist, who was basically saying that he was frustrated and furious at Robertson's obviously decision to reappoint him, where previously National had only reappointed I think it was Grant Spencer, for 6 months leading into the 2017 election. Mike Riddell has come out, and obviously he's a former Reserve Bank economist, and obviously he's definitely not an Adrian Orr fan. In regards to this credibility issue that probably both Adrian Orr and the Reserve Bank overall have, Does that mean that because of that, they are going to maybe have to push higher than if they had this, more of a credible reputation in the current market?
Yeah, I think that there's a whole lot of issues there, right? With hindsight, could the Reserve Bank or should the Reserve Bank have lifted interest rates earlier? The answer is yes. Yeah, but hindsight's a wonderful thing where you go back and you think about, did we really know what was going to go on in regard to COVID? The answer is no. So they took out one hell of a big insurance policy, and with hindsight, they should have pulled it an awful lot quicker. But yeah, every forecaster was running around in circles in the economist fraternity. We all got it wrong in regard to underestimated the strength of the economy. So you've got to be pretty careful. I get a little bit worried when people personalise things, because the Reserve Bank is a lot more than Adrian Orr. Right? There's an institution here, there's frameworks, you've got a board, you've got governance in place. And so if I sit back and think about this, there's probably a few things that worry me in regard to the Reserve Bank. Number one is at the moment your key priorities are the economic basics of getting the inflationary thief back in jail. Right? So let's focus on that, and a lot less about that woolly stuff that's sort of going on, and that's the polite way of how I'll describe it. Secondly is governance. Right? The Reserve Bank is an institution that covers banking, monetary policy, so you need people on that board that have got banking and got a specific economic expertise. Well, having a look at the expertise and the knowledge there, they don't have an awful lot of expertise in banking and monetary policy, and it was ironic. I think it was 12 months ago, the Reserve Bank called for an independent report on the board of Westpac, because the Reserve Bank had some concerns about whether the people on that board had sufficient banking expertise to be on that board. And of course, the report came back and says they didn't have sufficient experience to drive what they call constructive tension. To get the right sort of debates around the table. So, Westpac's done a good job in getting more people with specific banking expertise on their board, so they're ticking the Reserve Bank's box. And then you sort of turn it around and you shine the torch back at the Reserve Bank in regard to what's going on there, and you sort of scratch your head in regard to, hang on, you're telling Westpac to do this, but you have a look at the governance structure you've got in place, you seem to have lack those specific skills. The final thing and these things that you don't want to nitpick, but why on earth is the funding for lending program still in place? It was a liquidity crisis tool, right? They brought out the big guns. It was almost like the Reserve Bank was like little kids in a sandpit. They just wanted to play with the big toys, right? They were talking about negative interest rates even through 2021. They got the banks to get set up for them. The banks wasted a whole lot of money. The Reserve Bank of Australia stepped up and says, no, we've got no interest. Right? And this comes back to the whole idea of your social license. When you're doing what you think is the right thing, you've still got to sit back and think about, is this actually the right thing within society's generally accepted norms? And I think some of the stuff that they put on table just pushed them a little bit too much into the danger zone. And once again, they were just too keen to play with too many toys.
So you mentioned the funding for lending program, and that obviously gets switched off, I think, in about 2 weeks' time. What effect will that potentially have on rates? Because if I'm correct, that could potentially mean maybe more competition has to, the banks have to compete more on the term deposit market potentially.
And if you look at the term deposit market at the moment, the term deposit curve is basically 4.5% across the board. So it does mean 1 to 5 years. So that's still above the general rate of inflation. Below the rate of general inflation at the moment. So you take out a 1 year term deposit, odds are you're going to make a negative yield. But 2, 3, 4, 5 years out, and 4.5, that's not looking too bad. And remember what happened in the past couple of years is as those term deposit rates went congregating down, we had this insatiable chase for yield. Didn't matter whether it was residential property, whether it's commercial property. You take away any ounce of return across the so-called safe investment, what we call the risk-free rate. Banks are sort of a proxy for that in regard to term deposits. Not quite risk-free, but you think reasonably safe. This is not financial advice, by the way. But when those term deposit rates start to move up, you're putting more of an investment alternative on the table. And that's one of the reasons we're starting to see these wobbles between longer term interest rates and equities, the crypto sort of stuff, and the trade-offs between investing in property or other asset classes versus safer investments, because the risk-free cost of capital is a pretty important benchmark when you start to think where you put your capital to work. Risk-free rate goes down, we see a chase for yield.
Yep.
Risk-free rate goes up, well, yields have got to go up on the other side, and yields go up on the other side, well, we all know what happens to property values.
So kind of if we, I suppose, focus on mortgage rates, obviously everyone's keeping an eye on the OCR, but these other factors like funding for living program, having its completion date, I suppose looking over at the US, I believe it's good news that maybe their inflation is a little bit lower than expected, I believe.
Yeah.
On the flip side, I believe China's starting to talk about opening up again. There may be some inflation off the back of that. So all these other factors, if we just park the OCR to one side, what do you see, I suppose, from a global point of view, these other factors, their effect on interest rates as well?
Well, let's start with the good news. And we've seen in the past week early signs that US inflation is coming down a little bit quicker.
Yep.
Now, we need to characterise that because it's gone from in the low 8s to the high 7s. Well, the high 7s is still a pretty bloody big number. But what it's seen is that US 10-year bonds have sort of dropped from 4.2% to 3.8%, which is a pretty big movement in the space of a week. Risk assets, equities have sort of popped back up. So it looks like, let's just say the Federal Reserve has won a bit of a battle. But what we know at the moment is that central banks around the globe need to win a whole lot of battles to win the war. And that's the real challenge at the moment. Like central banks, I think, can get inflation from 7 to 8 down to 5. You just turn the commodity price cycle. We're seeing what's called global goods disinflation. So a lot of those bottlenecks that COVID centred have started to free up. Freight rates are still hellishly expensive, but they're not quite as bad as what they were. But we're starting to see an easing up in what's called goods inflation pressure, which is a big part of general inflation. But if you look at, we are no longer in that globally connected world we've been used to over the 1990s to 2010s period. Now there's real tension between China, the United States, Ukraine, Russian situation. There's a real concern globally in regard to security and food, technology and energy. We're still on the cusp of an energy shock. So there's a whole lot of, it looks like globalised inflation pressure is going to be a lot more persistent. And the other thing out there at the moment is just you look at the labour market, everybody's short of staff around the globe.
Around the world.
It's like suddenly a whole lot of workers have just completely disappeared. But it's a sign that the global economy is just running too hot to trot.
I was over in Melbourne a few weeks ago at Ryan's stag do, and it was interesting kind of going over there and just seeing the exact same thing we're seeing around Auckland's Viaduct. Half the bars basically with we can't open signs because we can't find staff in very, very similar situations.
And that's part of, I think, a big power shift going on away from employers towards employees. So one of the reasons we had low inflation for 30 years was that China. It wasn't just China and globalisation. It was just wages didn't move too much. Right. So there was an abundant source of labour, and employers really had the upper hand. What we're now starting to see both locally and globally is that there's a bit of a power shift that's going on. And it looks like the shortage of labour is not just going to be temporary because the population is ageing. The feeder system into the workforce is the schooling system of today. And you have a look at the schooling system of today and you'd be really worried about the workforce of tomorrow in regard to kids are not turning up to school. And if you don't turn up to school, well, you're not going to be turning up to work too much as well. So there's a whole lot of factors out there. Demographics. One of the reasons we saw lower inflation for a long time, people were saving. Well, now the people are hitting 65 plus and they're not saving, right? We call it the bucket list. I call it now. It starts with the letter F, no longer the letter B. And it personifies this attitude that people are just getting out there, and COVID's changed the DNA of people. Your life is short. I just want to get there and do stuff, buy the camper van. I want that place down in Queenstown. I want to get that e-bike. And now at the moment, you're off championing around Europe with these sort of things. But people are spending money. Like normally in this environment, you start to close the wallet a bit. So there's all these structural factors out there at the moment that just suggest, look, central banks, before they can claim a win through the war and inflation, there's a whole lot more battles they need to navigate through. So yes, glass are full. The Fed's won sort of round one, but let's see where we are in 6 to 12 months.
I find it interesting in regards to what you were saying about globalisation. I was reading a Financial Times article recently, which was basically saying this multi-decade I suppose, process of exceptionally cheap money, very, very cheap labour, very cheap energy is kind of coming to an end. And I suppose for people who are trying to figure out, we're going through this inflationary cycle at the moment. But when we get to the other side of it, it doesn't mean we're going back to pre-COVID 2019 mortgage rates, does it? There's going to be a change there.
Yeah, you go back and you have a look at a few defining trends of the last 30 years. Globalised, connected world. Well, we're not in a globalised, connected world. We're not in a lower inflation environment. It looks like we're in a more sticky, persistent inflation environment. You take out the tailwind of lower interest rates over 30 years, because this has been the playbook. Interest rates went down, they might have moved up a little bit, but then they came crashing down the other side, and it was lower lows over 30 years. Lower lows meant higher highs for property prices. Yeah. Higher highs for property prices meant you didn't need to worry too much about the yield on the property because you got the capital gain. Yeah. And you look at these sort of things, and it's, it was easy to make money. You didn't need to take a lot of risk because interest rates were the big tailwind at your back. And now, and let's think about some of the good side of what's going on. Yeah, now you need to take real risk to make real money. Yeah, fancy that. That's what putting a capital charge and rising interest rates into the equation actually do. And the good news out of this is that good players are going to flourish out of this because they know how to do numbers. They're going to identify quality assets. They're going to add value to those assets as opposed to the whole sort of idea of passive investing. You buy something that goes up, forget about it. Now you've got to be active. You've got to be adding value, working out. You can drive that additional income stream about it. Yeah, so people with good balance sheets, I think, are going to be looking forward to the next sort of couple of years and possibly licking their chops in regard to what could go on. Unfortunately, there's a few others on the other side that the pain's still around the corner in regard to interest rates have not moved up in regard to the cash flow impact. And of course, everybody's sort of thinking, well, what goes up comes back down because that's been the 30-year playbook. Well, what if the cycle we've seen for the last 30 years is not your normal cycle?
Yeah, and I mean, if you obviously there's so many variables that come into this, but if you're talking to people obviously investing from a long-term point of view, because there's going to be people online who've got good balance sheets who are going to be looking to, go hunting in the next kind of 12 months, but trying to figure out, how the numbers look from a mortgage point of view, from a long-term point of view. Any number that you'd, recommend they work off?
Well, let's have a look.
Because it used to, for years, we were recommending around 7%. And then, of course, for the majority of the last decade, at average, miles lower than that. So
let's go back to this sort of concept of what's called the neutral official cash rate. Right, the neutral official cash rate is the rate at which the Reserve Bank's neither got the foot on the accelerator or the brake. Yep. Now, the Reserve Bank estimates, and this is a mean estimate, it's like the average with a bit of a boundary around it. Yeah, way back in the early 2000s, they thought that number was up around 5.5. Now, over a 20-year period, it dropped down to 2%. Right, so what does that mean for mortgage interest rates? Well, mortgage interest rates basically dropped 350 basis points in line with the drop in the neutral OCR. So you sort of put a bank margin on top of your neutral OCR. So you would have been banking on maybe your long-term mortgage cost might have been around 4. Right? What if the neutral OCR is no longer 2? Yeah. What if it's 3 to 4? Yeah. Right? Then add your couple hundred basis points on top of that, and maybe the new normal is 5 to 6. Yeah, so the whole idea that, okay, maybe we're going to overshoot at the moment and we get up into the 6.5, something like that, but maybe then we come back down to 5 to 6, but 5 to 6 is a long way away from 4. Yeah. But the Reserve Bank put out a release with one of their documents, and they said some of the pieces of work they're going to be doing is examining a lot closer where that neutral OCR could be, because it's really critical in regard to thinking about your long-term cost of capital as an investor. And at the moment, it just look we overshot a little bit to the downside. So I look with a degree of skepticism when people sort of say that mortgage interest rates are going back down to 3.5 to 4% because the cash rate's going back down to 2% because that's the neutral rate. Yeah, I just think that sort of stuff, old school, where we've been in regard to inflation. It doesn't look like we're in the same inflationary environment we've been for the last 30 years. We're like globalisation, demographics, shift in worker power, government spending. Do you really think governments are going to ease up on spending? So especially in the next 12 months when it's an election year around the corner. ESG, that whole movement, it carries costs. Go to any farmer out there at the moment. There's a reason food price inflation is running at 10. It's because farm cost inflation is running at 15.
So you just raised, I suppose, government spending, and something I found interesting. There was a Herald article a couple of weeks ago, Thomas Coughlin basically saying that I think it's the budget policy statement will come out, obviously, where they're going to more put a number down in regards to what the new expenditure should be at the budget next year. Opinions on basically how that's going to play out, and will you be looking at that number and trying to look through that to see if that's inflationary at all?
So here's a situation if you're the Reserve Bank at the moment. The Reserve Bank needs help from the government to get the inflationary thief back in jail. What does that mean? Well, battling COVID, we need monetary policy and what's called fiscal policy to deploy all the assets and basically pump a lot of money into the economy, to provide a bit of an insurance policy. Well, now's the time for restraint and withdrawing a lot of that stuff. So the Reserve Bank is doing it, whether you look at liquidity, the large-scale asset program, ending of funding for the lending, interest rates moving out. Now is not the time for the government to be rolling out a big spending budget. Now's the time for restraint.
It seems to me that we could almost compare it a bit to going into the 2005 election, though, when the student loan bribe came out, though, that we could see something similar.
Well, listen, look, there's deep-rooted structural issues across New Zealand, right? You have a look at, we've got a healthcare crisis. Right? Who do we really value in society? COVID has actually worked out, we've undervalued nurses, healthcare. It's going to need a lot more money thrown at it. We've actually got a crisis, I think, in the middle in regard to schooling out there. We need to boost our presence in the South Pacific in regard to defence. Law and order needs a big funding boost out there. There is going to be, everybody is going to be coming cap in hand to the government for more money. And next year is an election year. So if you think the government of the day is going to be able to rein spending in an election year, go put some money on Italy to win the next Rugby World Cup, because I think they're about the same odds. But this is not just the government. You've got the opposition political party, the main one, is out there saying, we're just going to give people tax cuts. Well, tax cuts and spending increase are going to give you broadly the same boost to inflation on the other side. And this is where, look, policy making is really hard. And what we need out of the government is forget about demand management, right? Let's aim at boosting supply. Let's try to get New Zealand's anaerobic capacity to grow. The big one out there at the moment is just immigration. Glass up, for the last 3 months, migration numbers have actually started to look really good. The yearly numbers are still awful. So we've still lost 8,500 in the last 12 months. A lot of Kiwis just saying pack their bags, they're off. But we're starting to see early signs that people are starting to come on the door. But you go talk to firms out there at the moment, it's a bureaucratic nightmare in regard to getting people into the country.
Yeah, 100%. Yeah. So while I remember anyone, if you've got questions for Cameron, probably start throwing those in, because we will go to questions towards the end of this. A bit of a chat around lending, and as kind of I said at the start, you have another business where you work with businesses to try and help them navigate trying to get funding, which is a bit of a minefield with the banks. I saw something come through today, which is some Reserve Bank stats, where apparently the bank resi mortgage market's grown about 25% since 2019. So I think it's about 267 up to 335 billion. The non-deposit taking on that market's gone up about 200% in that same time, but it's still a fraction of the market. I think the whole non-bank market's under 2%.
Yeah.
But I believe they're writing about 7% of new mortgages at the moment. We were talking off camera basically earlier in regards to how the banks are not that great at taking risks. Obviously, the CCCFA has made it a very regulated type market, and it seems these days that they're basically just ticking boxes, and anything outside the box they're very, very hard to deal with. How do you see this kind of playing out over the next little while? Are borrowers going to have to get used to using more non-bank funders to access capital? What's your opinions here?
So there's a whole lot going on. So Christ, I could go all over the place on this one. But let's sit back and think
Feel free to.
What's the basic role of a financial institution or a bank? Like, a bank actually takes money and it packages it up from savers, offshore investors, and it deploys it into the economy. And that process of credit intermediation is a big part of fostering economic growth and economic development. And so do not underestimate the role that financial intermediation can do in regard to helping the economy get ahead. Now, with that as sort of a little bit of background, let's have a look at what we're seeing more and more out of banks over the past few years. They're basically becoming big bucket shops for home lending and not much for business lending. And some of that has been driven by the Reserve Bank in regard to getting banks to hold more regulatory capital. So if they've got to hold more capital, they're going to want capital relief. They get capital relief by lending in a house as opposed to lending to a business. So you're playing the short game as opposed to the long game. Now, if you look at across 27 banks, I think banks are going to crack $10 billion worth of profits in the year ended September, dominated by the big four. There's nothing wrong with making money. Right? Bank profits have been averaging growth of 17% per year. What we're not seeing out of the banking sector, they take real risk. So if you look at bank impairment expenses going back 10, 20, 30 years, their impairment expenses average about 0.1%. So what do? They package things up, right? But do they really take risk? The answer is no. And I sort of wonder whether that sort of stuff is holding New Zealand back. Yeah, and we're seeing an awful lot of people have left banks and they started to go work for non-banks, or they're offering this thing called service. Fancy that? Yeah, banks have become very vanilla in regard to their operations. And look, they're very well run organisations. They've got tremendously low cost to income ratios, which is a bloody big barrier in regard to someone else sort of competing. But what we've seen in the last 12 months is that the landscape started to change a little bit. And I think one of the reasons I set up Chaperone was not just because I knew we were heading into tougher times, but I think we could be starting to witness some pretty profound changes across credit and capital markets in New Zealand, and everything starts with a small step, right? But maybe housing's still going to be a good investment, but it's not going to be that turbocharged investment we've seen for the past 30 years. Maybe we need to learn to invest in the real productive part of New Zealand. What are the things that we need to think about in regard to credit facilitation, intermediation, in regard to get that ball rolling?
Yeah.
And I think that New Zealand is overweight donkey deep in houses, and we're underweight real productive stuff. Just have a look at the market value of the NZX versus the property market, compare us to Australia, the United States. So I think there's some profound shifts that are going to take place here, but people are going to need help along the way in regard to channeling those big structural shifts. The government's talking about moving to open banking, where you can sort of share information across banks that can help drive competition. Like these sort of things are sitting around in the background, but it's almost like we're still stuck in second gear in regard to what needs to take place.
Yeah.
And having those real tough conversations. In the meantime, you've got businesses out there at the moment that just like doesn't worry about the price of credit, just get me credit.
Yeah, 100%.
And we are moving into that. Yeah, the danger is we see a bit of sharking.
And I look at it, I suppose, in comparison. I set up KPM shortly before the GFC, and obviously that was a pretty interesting time to be an investment mortgage broker going into that world. But I look at it in some ways, I think it's more challenging. We're going into, interest rates drop through the floor, then they're going through the roof this stage. Also, it was a lot. Lenders you still had a lot of lenders with common sense. So while there were a lot of them who were very tight, a lot of the same regulatory platforms aren't there. Weren't there now that are there now. In regards to, for example, we'll talk about interest-only loans in a bit. The banks are still rolling over interest-only loans very easily. All this type of stuff.
I remember UDC prior to the GFC, and the UDC was being slaughtered as the underperforming finance company, and that's because they were sticking to their knitting.
Yeah.
They weren't there out there doing a whole lot of the creative sort of stuff where risk was not getting priced correctly. Once again, it's the balance between risk versus return, and making sure that you're getting both sides of that equation right. That's how you grow a more dynamic. What's one of the elements behind a more dynamic, productive economy in regard to just taking real risk and pricing for it.
So, do you see a lot more companies coming into the market over the next few years? Because I can definitely see from my side, we're seeing a lot more non-bank offerings. One of the issues which I suppose is holding back, especially the mortgage market, is a huge amount of those are wholesale funded through the banks. So they're still basically being restricted by the Reserve Bank regulatory rules, etc. If that makes sense. So to me, there seems to be a market more where you'll see. There's one company, I think, who had a funding line through Deutsche Bank, which was sitting outside the RBNZ mandate. They could still obviously have to meet FMA guidelines and all that type of stuff, but they could provide a product to the market, and most others weren't. Do you think more of that will come into the market over time?
Yeah, so let's look at just a simple indicator. The return on equity of the big four New Zealand banks is about 300 basis points higher in New Zealand compared to their Australian parents or equivalents. And I guess you look at that through an economic lens, and I sit there, there does not seem to be that much of an economic justification for that sort of differential between New Zealand versus Australia. So that tells me that there is a pool of money there that antagonists could chase.
Yeah.
And what we're now starting to see is that it's really hard for an organisation to get scale, to truly challenge. Just have a look at KiwiBank.
Yeah.
Right? They've been trying for a long time, and they're still a pretty distant fifth in regard to where they sit. But what we're now starting to see, it's coming out of Australia and other places, is that people are starting to cherry pick. You're starting to see a lot more boutique offerings that are coming through. And interesting, you're seeing an awful lot of former bank staff are sort of leaving banks and they're going working for a lot of these operators,
100%.
and they're taking real life these things called credit skills.
Yeah.
You saw the old correction ad on television?
No.
Oh, there's a great corrections ad on sort of television where this little was, what do you do? Or work for corrections, or what do you really do? Or I help people when this is it goes through. You made some bad decisions and you're locked up, and we're here to help you through and try to get you back on track. And then the corrections guys, well, what do you do? Oh, I'm a banker. Apologies to any bankers on the line.
And we can definitely see the same thing. Like we've seen a huge amount of people leave to become mortgage advisors, leave to go to the non-bank market, leave because they can go somewhere where they can actually think and actually feel like have some enjoyment in the role.
People want to do deals.
To be fair, I think to the banks, the feedback we're getting behind the scenes is that they are almost progressing to move to probably get rid of a whole lot of staff and replace them with technology. So you can kind of see that. You can see that happening behind the scenes.
It's not just that. If you look at your poor bank staff at the moment are so caught up in compliance, it's just regulatory overkill. Right, the triple CFA and that sort of stuff. It's like you're designed by people who've actually got no appreciation of what the lending process is all about. And I actually, when that came out, I wrote an article on it, and I called the Minister of the Times office and spoke to the person at MB that was running the inquiry and said, how many people in your division have actually worked for a lending institution? And the answer came back, we've got a lot of good policy people. And that's not what I asked. How many people have worked for any sort of financial institution? The answer was none.
Yeah, and we can see that frustration dealing with the banks over the last 12 months, and particularly on certain deals. There's just an absolute scarcity of common sense in regards to the ability to look through a transaction and go, this is a completely credit-worthy borrower.
To be fair, the banks put up within their assessment, this is what is going to be a consequence of that legislation. And there was a great line, I can't remember who said it, but the line was, because the minister and the official said, well, why are you behaving like that? And the response was, well, which part of our review assessment did you not read? Because we laid it out in black and white in regard to how this thing...
David Clark, wasn't it? I think
it was a bank spokesman said, we laid it out, that this is what is going to be a consequence of that legislation as you are adopting it at the moment.
Well, obviously, it hit December 1 last year, and so I remember we spent, I think, it was originally supposed to hit on October 1, and it got delayed because of the COVID lockdown. So I think we spent quite a bit of August, September in training, and the banks were throwing their toys up behind the scenes going, the amount of, they weren't happy doing the training. You could tell the frustration, and then made it very clear basically the whole way through, and you could see the train wreck coming, and obviously it hit the media, I think, January this year.
Yeah.
And obviously, in some parts have been rolled back, but it's going to cause a lot of issues, in my opinion, next year. I think especially when we start to see some people tip over, and the banks previously would have had some common sense to look at these people and sit there and go, okay, what are the ways we should be able to help them? That's going to be really interesting. And I suppose on that point, I'll throw a few kind of quick action points from my side for people to consider, and then I might throw it back to you to see if anything kind of you should add, because we're seeing a lot of people at the moment who are maybe used to rolling over interest-only terms, and they just roll them over again and again from a cash flow point of view. And at the moment, the banks are requalifying people, and if you don't meet the current bank's criteria, they're forcing you onto P&I. If you think about it from a logical point of view, it's quite unusual. If you can meet their affordability, you can have lower payments, but if you can't, we're going to make you pay more. Yeah. That's effectively what the banks are saying. I don't quite know how that works as common sense, but that's what they're doing. To me, maybe a case of, okay, you're not meeting criteria, we're having kind of concerns around your cash flow, we're going to give you one more year interest only, but we want to see maybe your process is settling down or something, would make common sense, rather than we're just going to absolutely jack your payments up through the roof right now. And I am worried about the regulatory framework not allowing banks to bring some common sense to that kind of argument. So for those of you, I suppose, who, you need to be very careful. Cameron's obviously mentioned about we're kind of still, the average interest rates, as he said, are still around that kind of 3.8 to 4%. If you're coming off the next 12 months, you're coming into a much higher rate. I think 1 year interest rates are averaging about 6% and everything else is higher than that. And for a lot of people, if you bought property in the last little while, the risk is if you're kind of going to get hit from going from an interest rate with a 2% moving to a 6 and you go from interest only to P&I, that's a massive jump in payments. I had a quick numbers kind of earlier on. If you got $1 million loan with those kind of jumps, you're talking about having to make an additional kind of $45,000 a year in payments, and on top of kind of everything else.
That number's after tax.
Yes. So in regards to pre-tax income, call that 70K. That's getting quite painful. And on top of that, from talking to accountants, many of you will know we kind of work closely with the Gilligan Road team, and talking to some of the accountants there in particular, they feel that a lot of people maybe not completely have got their head around the interest deductibility changes. And, that's going to be something which may hit, obviously, for existing properties. That's going to move to 50% on April 1 next year. So if you don't have your head around that, make sure that you're talking to your accountants and can be aware of how those changes are going to look. If you've got interest rates coming up, if you've got interest-only expiries, just get ahead of that. And feel free to talk to us, talk to your banker, just get an understanding of how your cash flow is going to be looking over the next 12, 24 months. You don't want a nasty surprise to be coming off a fixed rate and get absolutely slammed. If you're looking to sell, another point is many of you might have more than one investment property with the same bank. And historically, what the banks would do is if you sold the property, they would let you basically keep the residual debt to whatever the allowable loan-to-value ratio is. What the banks are doing now is they're testing you on their current affordability, and if you don't meet that, they're taking all of the sale proceeds. So we're seeing situations where people are maybe considering selling a property purely to get their hands on capital. That hits the market and the bank takes every single cent. So just again, get ahead of this, take advice maybe before you decide to sell, because if you're selling to get your hands on, to get your hands on some capital, you don't want to get a nasty surprise, because in a lot of cases selling in this markets, you're not going to maybe always get the best price. Insurances, you don't want to, this is a market, if something goes wrong from a health point of view, an income point of view, you don't want to have to do a forced sale. So make sure you're just reviewing your insurances if you haven't done that for a while. On the flip side, as you kind of mentioned, many of you, or quite a few of you, might actually have really good balance sheets. I know a lot of you, and there's some people who have actually been waiting for the last few years for a year like next year. So for those of you who are actually in a great position, get pre-approved and wait, because there's going to be some deals there. Any additional kind of things that you would throw in there?
Well, big thing that I think about at the moment is it's this whole concept of risk management, right? And do we have a precise playbook for the next 2 to 3 years? The answer is no. You go back and you have a look at the past 10 years, all this printing of money that's leveraged up bank balance sheets, and it's flowed into physical assets, including housing and equities. Well, we're now in an environment that in order to contain inflation, the liquidity tap's being turned off. Now, we conducted the world's biggest experiment when we went through all the big money printing episode, including taking interest rates down to zero. Some countries took interest rates into negative territory. Reversing that, we've never had to do that before. So anybody that gets up and gives you a precise prescription in regard to that, just, buyer beware in regard to what they say. But then this is where I come back and just put a risk management framework in regard to what's going on here. You don't just apply principles that you've learned for the past 30 years, because the past 30 years where interest rates just kept on trending down, it's been somewhat exceptional. We've been through a couple of downturns, the GFC, the Asian crisis. They were short and sharp. Asset prices reflated out the other side. And people that have been around a while probably remember the late 1980s. And that took a long time to creep up on us, and it really hurt on the other side. Well, that was the last time we really had to break the back of inflation. So history doesn't necessarily repeat, but it can rhyme in different segments. So to me, just risk management.
And on, I suppose, this inflation situation, obviously the Reserve Bank kind of come out and say it maybe so harshly, but they want to see some unemployment, don't they, to basically try and stop this wage spiralling going on, and that won't all go through equally. So some industries are going to get harder than others. Any particular industry you'd say to, if people, if they're in, they need to be a little bit careful over the next 12 months?
Well, the big cycle that needs to turn is the construction sector. Yeah, the construction sector tends to be a sector that has 3 gears, fifth, neutral and reverse.
Yeah.
It does really well at the top of the cycle. Housing and household operation, which includes rents, construction costs, is about 25% of consumer price inflation. Right. So you're not going to get consumer price inflation back down unless you really turn the construction cycle. So the indicators we're looking at there at the moment is not just building consents, but the attrition rate. A whole lot of those things that have been in the pipeline, are they really going to get built?
Yeah.
Or we're going to see a whole lot of stuff falter by the side, cost pressures, can't get finance, can't get pre-sales, these sort of things. And I think that's going to take place. So the construction sector is one of those ones, but there's a lot of work across construction. I go down to Dunedin and have a look at a big hospital that they're building there that's sucking everybody into the thing. The same thing's happening across other parts of New Zealand. Shortage of hospital-related stuff, education. Some parts of New Zealand, we've still got housing shortages. So Auckland's the market that worries me the most, because Auckland's depopulated in the last 12 months and we're still conceding 20,000 units per year. So Auckland's going to have a few challenges coming down, and the construction is a big employer. Right, so that sector needs to turn, and with that, we talk about job losses. Jobs is the one it's going to take place, but remember, firms make less profits along the way too. Right, there's households are giving back big gains in household wealth. If you look at the past, since January to June this year, household wealth has fallen by about $135 billion, which is a huge number. It increased $700 billion in the preceding 2 years. Right, so you're giving a bit back, but you can bet your bottom dollar between July and December this year, household wealth is probably going to be down $150 billion.
On that point, I remember we did a webinar last year. I think if my memory serves me correctly, I think you said it was around 3% of every billion house prices went up when it was discretionary expenditure. I think it was. Is it pretty true the same percentage on the way down?
Yeah, you'd sort of think
it'd suck out.
Yeah, I think it's 3 to 5 cents.
Yep.
Right, and I think it works both ways.
Yeah.
But I think the wealth effect this time around is going to be a little bit complicated in regard to what we spend our money on, because normally the wealth effect hits, particularly discretionary spend, which you put cars, renovations, spa pools, holidays into that bracket. Now, this time around, I don't think people are pulling back on holidays because we haven't been on holiday for a couple of years. Right, so the onus is probably more on those other sectors to take a bit more of a hit.
I've already heard the new car sales are through the floor, I believe, and stuff like that.
But that's the sectors that have done really well in the past couple of years, as we deployed a lot of local expenditure into New Zealand that we previously spent overseas, are going to find that going a little bit tougher. Tourism's coming off a really low base, but they've actually turned the corner, and anything is going to look better than 2020, 2021 to that sector, subject to getting staff, which is the biggest issue out there at the moment. The construction cycle is slow to turn at a time we're reconnecting on the other side. So there's huge overlap in regard to where the labour demand is. And in the meantime, it just adds to inflation.
Obviously, places, industries like hospital and retail had a pretty hard 2021 as well. Discretionary expenditure, if that kind of evaporates, those industries, how do you think they're going to go?
Well, the big thing for all sectors is margins. And it's going to be interesting to watch. There's a political aspect to this in regard to who wears the pain of inflation. Does it come through lower profits or does it come through job losses? Now, normally it'd come through both. If you look at what we're seeing in America, profits as a share of GDP are up around a record high. It looks like the same thing's going on in Australia. So there is an argument, it's logical, that the reason we've got a lot of inflation is just because firms are making too much money. Right? They're stitching you with the margins. So maybe it should be the corporates that wear a lot more of the inflationary pain as opposed to the workforce. And we're going to see, I think, some really interesting political debates over the next 12 months in regard to who wears the pain. COVID tax, wealth tax,
Great guys.
special one-off, right? Windfall tax coming through, or something towards the electricity industry the other day. But this is where we get, the government's going to need more money to support those most in need for the cost of living crisis. We've got the strongest labour market on record, but we've got, the food banks have never been busier. Right, so there's real division out there across New Zealand, but there's going to be a lot of point of the finger in regard to, well, who should pay? And if you're making a lot of money, the finger's going to get pointed at you. It's my suspicion.
So keep your head down.
Yeah.
Well, we'll open up to some questions. Just while I'm sorting this, one thing I did want to actually ask, because someone asked me to get your opinion, was, and throw through any questions if you've got them, people for Cameron as well. Couple of things, the Reserve Bank macro tools, LVRs, you think any relaxing this year? No? So basically the settings will stay the whole way through 23?
Yeah, I think it's going to take a while to get the inflationary thief back in jail.
Okay.
So it doesn't matter whether you look at that sort of tool, or whether you look at interest rates. I'm not a big believer that interest rates are going to go up and then we're going to start to see the official cash rate come back in 2023 or 2024. The Chairman Powell, the head of the US Federal Reserve, which is the most powerful central bank around the globe, talked about using their tools forcibly, and they didn't think he was going to take the foot off the throat for a while. They said this inflation dynamic just looks a lot more persistent. Which look, maybe we see an economic accident where China implodes. China implodes, then you got disinflation, and all of a sudden interest rates might come crashing back down.
And the other one of those, of course, is I saw the Reserve Bank financial stability report 2 weeks ago, I think it was today, that they're obviously still pushing ahead with DTIs. Do you think they're more just going to get that to a stage they can just put it in if they need to, but they're going to keep it on the back burner? How do you see that playing out? I'm getting a lot of people starting to look at debt to incomes, and especially in Auckland with how high our ratios are. That would make things pretty hard as well.
But the benefit of that sort of tool is that you don't need to deploy it.
That's there to go.
You just need to have it there, and having it at your disposal drives different behaviours across banks, because you don't want to be too far away from the broad principles, and they will come up with a set of principles in regard to this is sort of where we think things need to be. So the message to the lending institutions will be based, don't be too far away from that. And then if you're not too far away, odds are we don't need to deploy with it.
100%. So let's get into a few questions here. So first question is, and as Cameron said, he's not giving financial advice, and it's a bit hard when he doesn't know your individual position. But how many years would you be fixing a loan for right now?
At the moment, it'll be around the 2-year part of the curve. But I think that you've got to answer that question subject to your own balance sheet, what your risk appetite was. One of the big things that I go by in regard to stuff that I do is I apply what's called the sleep test. If I'm losing sleep over something, I tend to go a lot more longer term.
I've just done that myself. If you are watching via mobile or on tablet, click the bottom icon on the left. It says Q&A if you want to throw any questions through. Thank you, Colleen. Okay, so obviously we've spoken a fair bit about interest rates, but Kris asked, where do you see interest rates going in the next 2 years?
Well, the official cash rate is going to, I think, hit up in that 4.5% to 5% zone, which is sort of fully factored into the markets. And if we look at where
how much, if I can ask on that, so like if the OCR goes to like 5, how much further do you think fixed interest rates will go?
Well, this is where, if you look at fixed interest rates at the moment are a general, they reflect what the market believes the official cash rate is going to happen in the next 1 to 2 years, right? So expectations that the cash rate is going to go close to 5% is just about baked into the 1 and the 2 year rate. What we're starting to see is that once the curve maybe gets to 5, there's an expectation rates come back down. Now, if we don't see those rates come back down, then you'd probably say the 2 to the 3 year rate are undercooking where they actually need to be. Because they reflect a forward expectation of the official cash rate, not just where the official cash rate is today.
Is there a chance with the US inflation coming down, and obviously the overall curve's pretty flat at the moment, that we may not be too far away from seeing those longer term rates dip under the short term?
Yeah, potentially if we get into an easing cycle, but
which is always dangerous for people to start looking at
you go back and you have a look at why has the United States turned the inflation cycle a little bit earlier than everybody else?
Yeah.
Well, I think they're a lot more ruthless than most other economies around the globe.
Yeah.
You know, what they've also had is the benefit of a high US dollar.
Yeah.
Right? Everybody else's dollar's been low.
Yeah.
So, of course, when their dollar's high, all their input inflation for goods has been an awful lot cheaper.
Yeah.
Yeah, what we've seen in the past month, go have a look at the Kiwi US dollar. The Kiwi US dollar is up 6 cents.
Yeah.
Right? So now that US dollar is starting to come back down and we're starting to go back up. So it's all fun and musical cheers in regard to who gets the benefit of currency relief. But what America did was that they basically exported their inflation problem, which has helped them in the near term. Now it's starting to kick back a little bit. But the real problem here for all central banks is what we call service sector inflation. And a big driver of service sector inflation is wages, it's unit labour costs. And that's why the battleground here, economists simplify it into inflation versus jobs. Well, jobs is just the last cab off the rank. There's a whole lot of things. There's asset prices, there's growth, there's a profitability cycle, there's cost cutting, all that sort of stuff along the way.
People taking out loans post-COVID may now be upside down or not equity. Should they be worried when interest rates are up for renewal? I suppose it comes down to if they can make their payments, doesn't it? I mean, there'll be some people, I suppose, who potentially, I've known first home buyers who are going in. To me, that would only apply to the first home buyers with low deposits who are buying in 2021. Would that be fair to say?
Yeah.
Who might be a little bit upside down?
Yeah. So there's, if you're a main bank, the last thing you want to do is to force things to a mortgagee sale. So if people have got the ability to make the payments, you're going to work with them because that's the better outcome for both, for the bank and probably the individual.
Yeah.
But what we're seeing out there at the moment is that, the Reserve Bank within their financial stability report put some numbers and what portion of people could be in negative equity under different house price scenario falls from here, like another 10%, another 20%, and another 30%.
Yeah.
And the numbers get quite dramatic, up around 20 to 30%.
Yeah.
Now, remember, house prices are already down, depending on your area, anywhere sort of 10 to 15, 18 in Auckland, this sort of stuff. So
Wellington's more, is that right?
Wellington's up around 20 at the moment. So Wellington had one hell of an economic party house price wise over 2020, 2021. I can say that because my main residence is in Wellington. So I've been using the phrase for a long time, eat like an elephant, don't expect to pass wood like a mouse, in regard to there's payback on the other side in regard to if you weren't banking on your house, so to speak, does it really make a difference?
Yeah, that's your residence. What is this one? Any comment on? Okay, I'll go back to that one. Sorry. What is the prediction on house prices, or the house price trend for the next 6 months to 1 year? I suppose that comes down to how much you think rates are going up and how much they're coming down. Yeah,
well, look, to me, who cares for the next 6 to 12 months?
Yeah.
Right? 5, 10, 15, What we are seeing within the property market is that the property market that was overinflated has been deflated by two means. One is house prices are coming down, but two, incomes are coming up. And that income support is a really important crutch in regard to restoring housing affordability. The more important thing to me, particularly if you look at housing as an investment, how's the housing market going to perform for the next 10 years? Because we know the historical playbook that people roll out, house prices double every 10 years. Well, house prices double every 10 years if interest rates keep coming down, right, at a certain rate. And we go back to that neutral official cash rate, it dropped 350 basis points. So every cycle, the interest rate's basically down 150 basis points, which adds a lot into house prices. Now what say, interest rates move up, but they don't change for a decade. What's going to drive house prices along?
Yield.
Yeah, it's got to be yield income. It's got to be, what's your expectation for household income for the next 10 years? You'd probably say household incomes grow up at 5. Now, to get house prices back down to more acceptable norms, you'll probably have house prices growing a little bit slower than incomes. So maybe the historical average has been 7.3 every year. 7.3 every year, you double every 10 years. Yeah, so maybe somewhere around the 4 sort of looks more normal in regard to what you'd expect. The interesting variable is going to be inflation.
Yeah.
Because inflation is both a threat to house prices because it adds to interest rates pressures.
It gets rid of the debt, though.
It gets rid of the debt, and it also, so if you look at the property market at the moment, think about Auckland. Yeah, you've got construction costs up 20, and you've got the value of the existing stock is down 19 since the peak October, November last year.
Yeah.
So you've got a big swing here of basically 40% from one to the other.
Yeah.
Right. And that people will eventually look at the existing stock as opposed to the new builds.
Especially if it looks like there's a change of government and the technology changed.
Yeah, but also like you start to think about, you can't afford the build, the wait time, you don't have certainty over pricing. So, or maybe we swap houses and we just undertake a pretty expensive renovation. So you're going to start to see those sort of switches take place within the market.
Yeah, I'm expecting personally, if it does look like there's a change of government, we might go back to a lot of the more old school investing of people finding properties they can do up and add value and increase yield and all that type of stuff kind of coming through.
Yeah, but it's not passive. It's intensification, and it's a focus back to the E.
Yeah.
Right, getting that earnings stream coming up. Because
on that point, we had a webinar with the guy David Faulkner, who's the general manager for property brokers. And so I think they've got one of the largest rent roll in the country outside of Barclays and the government. And I remember him saying that pretty much, in the regions and stuff, and this is 6 months ago, everything was exceptionally tight. Rents were still coming up. Well, that I haven't actually spoken to him in a while. Do you need any feedback on how rents are going lately? I had heard that they were in some cases starting to come down.
We're starting to see some of that pressure in the regions come out. But what we saw, and it was 6 months ago, was that Auckland was very clearly softening. And where we were seeing the biggest acceleration was in regions.
Yeah.
And I think we've pushed a whole lot of housing shortages from Auckland out into the regions. Yeah. So if you go back and have a look at the last 3 years, Auckland's lost about 35,000 people into what's called intra-regional migration. Now, pre-COVID, that was band-aided by a whole lot of external migration coming. So Auckland didn't really notice those intra-regional migration trends. Now, I think that intra-regional migration trend is continuing. And you just go down to Cambridge, you have a look at Tauranga, you have a look at the southern parts of Northland in regard to what's going on. Now people are starting to flood into Taranaki, Hawke's Bay. You go to the builders down there, they're being inundated with things. And this is, things such as crime, law and order, like the ram raids, these sort of things, is just they're incentivising people to go work somewhere else, and working from home is another one. Yeah. Why would you not go want to live in somewhere like the Hawke's Bay and collect an Auckland salary and pay a Hawke's Bay house price? So there's a whole lot of structural changes that are going on in the market. But what we've also seen is that the biggest supply side response has been in Auckland. So of the 50,000 building consents in the last 12 months, Auckland's issued 40% of those. 20,000, for a city that's actually depopulated.
Yeah, and my understanding is in previous down cycles, people tend to go back to the main cities. But with these structural changes, with people working from home more and stuff, we're not necessarily going to see as much of that, are we?
Well, potentially, but there's still a cycle. Yeah. So there's regions are different. Yeah. But there used to be a broad sort of rule of thumb. If you look at a regional house price would typically be 60 to 80% of Auckland, depending on the region. All right. So when you saw a region getting down to being 60% or below of Auckland prices, you start to see a big flow of capital out into that region because the yields just looked a lot more attractive.
Amazing. Yeah.
Right. I can remember just prior to the GFC, the amount of money that was flowing into Tokoroas and these sort of places. Right. We saw the same thing again in the past couple of years, where money just ploughed into regional New Zealand. Now, there will be a time where we're going to see that pivot back the other way, where Auckland will become attractive again from a valuation perspective. And we are seeing Auckland is headed into this thing an awful lot early, and we all know that Auckland leads. Yeah. And it leads down and it leads back up the other side. Yep. So there's a cycle to watch.
Yep.
It's just a question of backing up.
Any comment on how the World Economic Forum's agenda and the Great Reset will affect the New Zealand economy? Does that ring bells to you?
Now that term, Great Reset, is something that probably needs a little bit of explanation. Like, if you think about COVID and a whole lot of things that we're going through around the globe, they're what's called negative supply shocks. Now, a negative supply shock does not make you richer.
Yeah.
It actually makes you poorer. And what's happened over the past couple of years is that to try to cushion the blow, we've pumped such a lot of money into the economy, whether that be through government borrowing, central banks printing money, interest rates down to record low levels, asset prices through the stratosphere. We sort of forgot that this thing is actually a negative adjustment we need to take place.
Yeah.
Yeah. So we've cushioned everybody. We've sort of wrapped everybody up in cotton wool. And now there's a little bit of reality that's starting to come through. Well, this is actually a reset. We sort of bought ourselves time to work out how we're going to deal with COVID and the negative aspect to it. Yeah, so there's a whole lot of resources that we need to get tied up within the health sector that could have been previously deployed in other areas of New Zealand. Yeah, obviously, you think about COVID's been awful for productivity on site, that sort of stuff. It looks like we might have another wave over Christmas. These staff shortages, people don't turning up. It's atrocious in regard to running a business.
That's horrible. Yeah.
Right, but this is just the reality of dealing with a supply shock.
Yeah.
Is that you need to reset. And the problem out there at the moment is society doesn't really want to reset.
Yeah.
But it is a negative supply shock, and we need to get our heads around that. The problem is everybody likes to feel wealthier.
100%. People don't like the other side. That's a good question. If my fixed mortgage rate expires in the next 6 months, would you consider breaking and refixing now? I suppose this goes back to what you were saying, that a lot of it's already been priced in, isn't it?
Yeah, a lot of it's priced in, and yeah, depending on your circumstances. Look, have I ever broken anything? The answer is no. Yeah, what you tend to find out is that the benefit of what you get on one side is offset by the break fee on one.
Yeah. This is a good question as well on the back of, I suppose, what you're saying about the construction market, etc. Is this still a good time to develop, subdivide and build, or would you be waiting 6 months or longer, the current market? And again, I suppose it comes down to someone's personal position, the project in general, who the builder is, etc. But looking at the construction market, what would you be doing?
Right, so I've got a place I've got through one of my little businesses, and we bought a place in Wanganui. We renovated that, and the plan was to put 2 more units on it.
Yeah.
I've been on hold.
Yeah.
And the reason I've been on hold was that I just couldn't get the pricing certainty that I wanted.
Yeah.
Now, at some stage, I'll kick through with that, but it was just being a little bit more patient, and just once again putting a bit of a risk management hat on what's going on there. But a lot of it comes down to personal circumstances. And one of the things that, if you think about what rising interest rates mean you now need to take real risk to make real money.
Yeah.
Now, if you've got real confidence in your ability to take real risk and manage that, then back yourself.
It comes down to individual balance sheets and all this type of stuff.
But a lot of it is about the ability to execute.
Yeah.
And what we've known, the Reserve Bank's Financial Stability Report had a whole lot of warnings within that over the property development sector. Why? Because a whole lot of people have jumped into it because it's been pretty easy money. Well, it's not traditionally pretty easy money.
Yeah. But this is the part of the cycle we find a lot of them start falling over. Do you think government implemented DTI, or I suppose more Reserve Bank implemented DTIs will come to fruition, or they let the banks self-regulate? If you have any idea of what number they might use.
Well, I hope the stick or the sort of broad parameters that the Reserve Bank puts out there is enough for the banks to play ball and they effectively self-regulate as opposed to deploying the tool.
Do you think a national act government will help the economy or hurt it? Obviously, it's a quite open question. There'll be pros and cons there.
Right, New Zealand at the moment, the Labor government deserves some plaudits for the COVID response. Yeah, we needed to go big, we needed to go hard. What is now coming to fruition more and more is that we are severely off-piste in regard to economic direction. What's called, it's now popcorn season and everything's starting to pop. Inflation, the current account deficit, our national chequebook, crime, declining school attendance, local authority finances, the government finances are going to turn a very severe downward corner in the next 6 months. So there is a big economic repair job around the corner for any government of the day.
Yeah.
If I have a look at what we're seeing within the political arena, one of the things that frustrates the hell out of me is that the opposition political parties seem to be out there just sort of saying, we're going to give everybody tax cuts. Now, tax cuts would not be part of my economic package for New Zealand in regard to what I think we need to be doing for the next 5 years. It will be well down the list. But for some reason, that seems to be what they want to deliver and what society seems to be paying for. But if you want an economic barometer or something to go hell for leather on in regard to making New Zealand a better place, I challenge anybody to pick a better economic indicator today than as to where New Zealand is going to be 20 to 30 years down the track than what we're seeing across the education sector. And if you ever look at education today, attendance, achievement, and all the stats are now starting to come out, you are going to be truly horrified about where this economy could be in 20 to 30 years.
They're atrocious.
So to me, one political party needs to grab the education sector by the scruff of the neck and turn the goddamn things upside down. At the moment, I'm seeing too much debate, rhetoric, over putting money back into people's pockets, i.e. to me, tax cut of 39 to 33 cents in the dollar. I don't want it. I want some real substance policies on the other side.
Even if the property price increases a bit slower, the income increase will comparatively make the debt more affordable to repay, which means the debt is decreased comparatively. So property is always a good investment, isn't it?
It's a good investment, but not the turbocharged investment we're seeing on the other side. Yeah. And I guess investing is all about relativities.
Okay, just a couple more questions here. Do you think construction costs will decrease with the expected downturn in construction activity ahead?
Yeah, so if you model construction costs, typically lag house prices by about 3 to 4 quarters. Now, obviously, COVID and supply chain problems have sort of created a bit of a wedge between that historical relationship. But the last piece of modelling I did for construction costs suggests to me we're going to start to see some construction cost deflation in the first 6 months of 2023.
Okay. And how far do you see the Auckland market dipping over the next 6 to 12 months in regards to sale price?
So
I think you said before, what, for 18% you're talking about?
Well, it's down 18% from its peak, which was October, November last year. Yeah, I think Auckland's heading into a 25% zone.
5% also, yeah.
Yeah, which you see, you're sort of getting there or thereabouts. A lot of the relief, the help, is just going to come from one, inflation on one side, but also the income boost that we're seeing across the board in New Zealand at the moment. You can deflate things quite well from incomes moving up, which mitigates the potential for things to move down on the other side. So if you ever look at average weekly earnings, the latest quarterly employment survey, it's up about 8 to 9% for the private sector.
Yeah.
Well, that's massive in regard to how it helps the property market out.
Yeah.
Now, unfortunately, inflation's up 7.2. So you're sort of you're 2% on the positive side of the ledger, and your increase in mortgage costs are going to chew up a fair bit of that. But income growth is still moving up. I come back and I still think that the biggest story here is not just the next 6 months. You think about this through an investment lens, and you think about what is a stable equilibrium for Auckland and New Zealand house prices over the next 10 years. Particularly relative to your cost of capital, which your cost of capital is going to be a lot higher than what it's been for the past 10 to 15.
Yeah. And people, in most cases, probably they should be looking at long term anyway, rather than the next little while. Fantastic. So I want to say thank you very much to Cameron. We will get a EDM out to you probably the next day or two, just to actually reiterate some of those points I made earlier. It's going to be a challenging year, so you make sure that you kind of keep yourself safe. If you want a review to kind of catch up with myself or one of the team to make sure that your kind of finances are looking okay, happy to do that. On the flip side, if you wanted to get in a position that you can take advantage of those opportunities, we can also help you there. So a big thank you for coming in.
Oh, thanks for having me.
Thank you.